IAS 23, borrowing costs. Borrowing costs. By borrowing costs, we mean the interest and other costs incurred in connection with borrowing of funds. The interest and other costs incurred in connection with the borrowing of funds. That is borrowing costs. Before the transition to IFRS, we used to expense all borrowing costs. That is all interest. We used to charge them as an expenses. But IAS 23 said that it's not all interest that should be charged as an expenses in the statement of profit or loss. There are interests that relate to the acquisition, construction, or production of qualifying assets. Those interests should be capitalized. That is, interest that relates to the acquisition, construction, or production of qualifying assets should be what? Should be capitalized. Those borrowing costs that relates to the acquisition, that is the major principle. Those borrowing costs that relate to the acquisition, construction, or production of qualifying assets should be capitalized. Other borrowing costs should be expensed. That is, if the borrowing cost doesn't relate to the production or construction or acquisition of an asset, you should charge it as an expenses. But the moment that borrowing cost, the moment it is incurred in acquiring an asset or production of the asset, so if it relates to an asset, that you should capitalize it. By capitalizing it, it means you should add it to the cost of the asset. But other borrowing costs should be charged as an expense. That is the requirement of IAS 23. Borrowing costs include interest on bank overdraft and short-term and long-term borrowings, amortization of discounts or premium relating to borrowings, finance charges in respect of leases, exchange differences arising from foreign currency borrowings to the extent that they are regarded as an adjustment to interest costs. I repeat, borrowing costs include interest on bank overdraft and short-term and long-term borrowings, amortization of discounts or premium relating to borrowings, finance charges in respect of leases, exchange difference arising from foreign currency borrowings to the extent that they are regarded as an adjustment to interest costs. These are the examples of borrowing costs. Then we have qualifying assets. Qualifying assets. What do you mean by qualifying assets? They are the assets necessary. Assets necessary or qualifying assets are assets that necessarily takes a substantial period of time to get ready for its intended use or sale. Asset that necessarily takes a substantial period of time to get ready for its intended use or sale. That is qualifying assets. So examples of qualifying assets are inventories, manufacturing plant, the power generation facilities, intangible assets, and investment properties. So that is qualifying assets. So we want to, when we used to start capitalizing the borrowing cost, that is what we mean by commencement of capitalization. So commencement of capitalization. Commencement of capitalization. Capitalization of borrowing costs to commence when the expenditure for the asset is being incurred. When the expenditure for the asset is being incurred, then you start capitalizing. Then 2, borrowing costs are being incurred. 3, activities that are necessary to prepare the asset for its intended use or sale are in progress. It is then that you can start capitalizing the borrowing cost. So, whichever one. So, if the expenditure is incurred, an expenditure may be incurred and the borrowing cost, and the borrowing cost too are being incurred. So, it is then that you start capitalizing it. Then, suspension of capitalization. Borrowing costs should be suspended. That is, you should suspend. That is, to stop for a while. You should suspend the capitalization of borrowing costs when capitalization of borrowing costs should be suspended if active development is interrupted. If active development is interrupted for any extended period. If active development is interrupted for any extended period, then you suspend the capitalization. Then, cessation of capitalization. Cessation of capitalization. By cessation, we mean when the capitalization should stop. That is, when you should stop capitalizing the borrowing cost. Cessation of capitalization. So when should you stop capitalizing the borrowing cost? When the activities necessary for the development or construction of the asset has been substantially completed. It is then that you will suspend. When the project has been what? Has been substantially completed. Although a minor modification may still be required. Minor modifications may still be required. That is when you will stop capitalizing the borrowing cost. So we want to take questions as work examples. Example 1. This question is obtained from ACCA study test by Kaplan. On 1st of January 2005, Saint Co. began to construct a supermarket which had an estimated useful life of 40 years. It purchased a leasehold interest in the site for $25 million. The construction of the building cost $9 million, and the features and fittings cost $6 million. The construction of the supermarket was completed on September 2005, and it was brought into use on 1st of January 2006. Cisco borrowed $40 million on 1st of January 2005 in order to finance this project. The loan carried interest at 30% per annum. It was repaid on 30th of June 2005 and excess required. Calculate the total amount to be included at cost in property, plant, and equipment in respect of the development at 31st December 2005. That is the question. Now, the first thing we want to do is that you ask yourself, when does the activity or the development commence? And when was the borrowing cost dropped down to this project? When was the borrowing cost dropped down to the project? On 1st of January 2005, Cisco began constructing a supermarket. So the construction work commences as 1st of January 2005, which had an estimated useful life of 40 years. It purchased a leasehold interest in the site for $25 million. The construction of the building cost $9 million, and the features and fittings cost $6 million. The construction of the supermarket was completed on 30th of September 2005, and it was brought into use on 1st of January 2006. So the building work was completed as at 30th of September 2005. That is the day the project was assumed to be completed. You don't need the date it was brought into use. Since it was completed as at 30th of September 2005, any borrowing costs after this period should be will cease. The capitalization of borrowing costs will cease as at this date. So there will be no further capitalization from September, after September 2025. Cisco borrowed 40 million on 1st of January 2025. The borrowing cost was drawn down as at 1st of January 2025. So that means the capitalization of borrowing costs will commence as at this date. Then you should also check. Now you have identified the date the capitalization will begin. Then the date the capitalization should cease, which is September 30, 2025. Capitalization will commence as at 1st of January 2025, while the cessation of capitalization will be as at 30th of September 2025. So you also check if there is any period or months between those periods in which the borrowing cost should be suspended. So, and that there are no information as regards that. So that means the period of capitalization will be from January 2025 to September 2025, which is 9 months. So you are going to capitalize the borrowing cost for 9 months. Cisco borrowed 40 million on 1st of January 2025 in order to finance this project. The loan carried interest at 10% per annum. This is the coupon rate of interest. It was repaid on 30th June 2026. You don't need the period of repayment, meaning that the interest relating to October 2025 to December 2025 will be capitalized, will be expensed in 2025 financial year. You are going to charge that one as an expenses in 2025. While the interest for a period of January 2025 to September 2025 will be capitalized as part of the cost of the asset. The interest relating to October 2025 to December 2025 will be expensed while in 2025 financial year. While interest for January 2026 till the date of repayment, which is 30th of June 2026, will also be expensed in 2026 financial year. So the only interest that will be capitalized will be the interest from January 2025 to September 2025. So you have to calculate the total amount to be included at cost in property, plant, and equipment. So property solution. So we have the cost of the property, plant, and equipment. Property, plant, and equipment. So the cost of the property, plant, and equipment, so we include one, a leasehold, purchase a leasehold interest. So we have leasehold, which is 25 million. 25 million. That is for leasehold. Then we also have the construction of the building cost 9 million. Building construction. That one is 9 million. Then we also have features and fittings cost 6 million. Features and fittings. That one costs 6 million. The construction of the supermarket was completed on 30th of September 2025. So if you aggregate it, 25 million plus 9 million plus 6 million, that would be 40 million. 40 million. Then, how much will that be the borrowing cost to be capitalized? Borrowing cost now, that will now be capitalized as part of the cost of the asset. So what is the coupon rate? The coupon rate is 10% per annum. Calculate 10% of 40 million times, I added K because of the 3 zeros I've kept at the top, times interest for January 20x5 to September 20x5. That is 9 months. So that is why I have 9 over 12. 10% of 40,000 will be 4,000 times 9 divided by 12. The borrowing cost to be capitalized will be 3,000. So when you add it, it will be 43,000. The amount to be included as property, plant, and equipment in 20x5 financial year will be 43,000. So that is for that. We have a group of assets. Where the construction is funded from different sources of borrowing. Then the capitalization rate should be the weighted average cost of borrowings, where more than one source of borrowing is used to fund the development or construction or a project. The capitalization rate should be the weighted average cost of borrowing. To calculate weighted average cost, it should be total interest from all the sources for the year over total borrowings times 100. This will give you the weighted average cost of borrowings. Let's look at this question. Example 2. Runico had the following loans in place at the beginning and end of 20F6. You have the January 20F6 and 31st of December 20F6. 10% bank loan, repayable 20F6, that is 120 million. 9.5% bank loan, repayable 20X9, that is 80 million. And 8.9% debenture repayable in 20X7. So at the end of the year, it was 150 million. The 8.9% debenture was issued to fund the construction of a qualifying asset, a piece of mining equipment, construction of which began on 1st of July 2006. This 8.9, it was used to fund construction of a qualifying asset. That is a specific asset. So the capitalization rate for that will be the cost of that asset. The 8.9% of the cost of the asset. That will be the capitalization rate. On 1st of January 2006, Akurnico began construction of a qualifying asset, a piece of machinery for a hydroelectric plant using existing borrowings. Expenditure drawdown for the construction was 30 million. On 1st of January 2006, 30 million. On 1st of January 2006, and 20 million on 1st of October 2006. We require to calculate the borrowing cost that can be capitalized for the hydroelectric plant machine. Now this one, the 8.9% relates to the construction of a piece of mining equipment. But other ones, the hydroelectric machine will be funded with the existing borrowings of 10% and 9.5%. So this one is excluded because this one has been spelled out for the mining equipment. So that means since more than one source of borrowing were used to fund the hydroelectric plant machine, therefore the capitalization rate should be the weighted average cost of the borrowing. To compute the weighted average cost of the borrowing, you calculate the total amount of interest. So you calculate the total interest from all sources, total interest from all sources of the borrowing, total interest from all sources. One is 10% bank loan. So we have bank loan, which is 10% of 120 million. 10% of 120 million. The interest on bank loan will be 12 million. Then we also have bank loan again, another bank loan repayable in 20S9. Bank loan. And that is 9.5% of The amount of the loan is 80 million. 80 million. So we calculate 9.5%. 9.5% of 80 million, and that will give us 7.6 million. 7.6 million. When you add it, you have 19.6 million. So that is the total interest. I've told you that to compute the WACC, you have the total interest, which is 19.6 million, over the total loans or total borrowings. The total borrowing is 120 million plus 80 million. And that will give us 200 million times 100, which is 19.6 over 200 times 100. So that will give us 19.6 divided by 200 times 100. The weighted average cost of borrowing will be 9.8%. 9.8%. So, that is the capitalization rate. Having computed the capitalization rate, then the next thing is to compute the borrowing cost to be capitalized. Now, borrowing cost to be capitalized now. So, on 1st of January 2006, Akunico began construction of a qualifying asset, a piece of machinery for a hydroelectric plant using existing borrowings. Expenditure drawdown for the construction was 30 million on 1st of January 2006. So borrowing costs to be capitalized now. Borrowing costs to be capitalized. As at January, one of the expenditure was drawn down as at 1st of January. So we had January 1st. And the capital and the amount drawn down was 30 million. And the accounting year, since it is December, the accounting year is December. Okay, let's see when it will be completed. Expenditure drawdown for the construction was 30 million on 1st of January and 20 million on 1st of October. Calculate the borrowing cost. So the accounting year end is December. So from January to December is 12 months. So 9.8%. 9.8% of that 30 million times 12 months. Out of 12 months, since it was drawn down as at 1st of January, that means it will span throughout the whole year. So we calculate 9.8% of 30 million, and that will be 2. Then, the second one, on October 1st. October 1st of the same year, 20x6. 20x6, October 1st, which is also 9.8% of 20 million was drawn down, times. Since it was drawn down as at October to December, that is October, November, December, that is 3 months, times 3 over 12. That will give us 9.8 million, and 9.8% of 20 million times 3 over 12, and that will give us 490. 490. So when you add it to 2940, so it will give us 3430. 3430. That is the amount of borrowing cost to be capitalized in 20x6. Where the surplus funds, or where part of the borrowing costs are temporarily reinvested, the borrowing cost to be capitalized will be the total borrowing cost less investment income received from temporary reinvestment. I repeat, where the surplus funds are reinvested temporarily, the surplus fund where it is reinvested, the borrowing cost eligible for capitalization will be the total borrowing cost eligible for capitalization less investment income from the investment. That is the income you earn from that investment. That is investment of the surplus funds. So now, that's what I mean by reinvestment of surplus funds. Now, let's look at the question. Grim term. Grim term. This question is obtained from Kaplan study test. ACCA. Grim term took out a 10 million 6% loans on 1st of January 2021 to build a new football stadium. Not all the funds were immediately required, so 2 million was invested in 3% bonds until 30th of June 2021. Construction of the stadium began on 1st of February 2021 and was completed on 31st of December 2021. Calculate the amount of the interest to be capitalized in respect of the football stadium at 31st of December 2021. The loan was obtained as at 1st of January 2021, but the construction actually commenced as of February. So it is the date the construction commenced now that the capitalization will start. If the construction starts as of February and the loan is obtained as at March, that means the capitalization will start from March. But since the loan was obtained as of January and the construction began as of February, it is this date that the capitalization of the borrowing cost will start. So now, the capitalization of the borrowing cost, I said it will start from February. That means the borrowing cost incurred for January will be expensed. So, borrowing cost now, capitalization, borrowing cost eligible for capitalization, borrowing cost eligible for capitalization. We have the interest on the loans, which is the loan is 10 million, and the rate of interest is 6%. 6% of 10 million times, this loan was obtained as of 1st of January, but the construction starts as of February. This is the date the loan will be dropped down. It will be drawn down as of February to the project. Since it will be drawn down to the project as of 1st of February 2021, it is 1st of February 2021 that the capitalization of the borrowing cost will start or will commence. So we have times 6%. So from February to December now, that is 11 months. 11 over 12. So that will be 6% of 10 million times 11 divided by 12. That will be 550,000. Then you now less investment income. Investment income. Since 2 million was temporarily reinvested, 2 million was temporarily reinvested as at, that means the investment will start from 1st of January, but the project has not commenced. The one that relates to the assets, at least the one that relates to the project, will start from 1st of February. That means investment income now, you are going to deduct. The rate of income is 3%. The income rate is 3%. You have 3% of that 2 million times, it was invested. That means the investment income will start from January 20x1 to June 30 20x1. That means the investment income will be for a period of 6 months. January 20x1 to June, since the investment was made as of 1st of January 20x1, and to June 20x1, before the 2 million will be required, and that 2 million will later be drawn down to the project as at 30th of June 20x, as at 1st of July 20x1. The 2 million will be drawn down to the project. Then it will no longer be available as investment as at 1st of July 20x1. So from income now that will be earned will be from January to June, which is 6 months. Out of the 6 months now, January, the project has not commenced as of January. The income for January will be taken to profit or loss. It will not be treated as, it is not related to this asset. So that will be taken to profit or loss. While the income for February to June, which is now 5 months, is the one that relates to the asset. So you calculate the one that relates to the asset, which is 5 over 12. So 3% of 2 million times 5 divided by 12, that will be 25,000. If you deduct the 25,000 from 550,000, then you'll be left with 525,000. That is the borrowing cost eligible for capitalization as the cost of the asset in the statement of financial position. So now, but your statement of profit or loss, you will have finance costs. You will have finance cost. That is interest for January, when the project has not commenced. Interest for that period, which is January, will be charged as an expenses in the statement of profit or loss. So under your finance cost, you have 6% of 10 million times 1 month out of 12 months. The month of January alone, which is 6% of 10 million divided by 12. That would be 50,000. Then you also have finance income in the statement of profit or loss. The income for that same January, which is 3% of 2 million times 1 month out of 12 months. So that will give us 5,000. This finance cost is an expense, while income is an inflow. So that is the extract of the statement of profit or loss. Then we want to take one more example. Question 4. Question 4. This question is obtained from BPP study test. ACCA, BPP, ACCA study test by BPP. So, on 1st of January 2006, Srimatco borrowed 1.5 million to finance the production of 2 assets, both of which were expected to take a year to build. The amount borrowed is 1.5 million, and this loan was borrowed as of 1st of January 2006. Work started during 2006. The loan facility was drawn down and incurred on 1st of January 2006. So that means they started using the loan as at that same date, which is 1st of January 2006. That means the commencement date of capitalization will be January 2006, since the 2 periods coincide, and was utilized as follows, with the remaining funds invested temporarily. So they invest it. No, if you add this, it will be 500. This is 1 million. Total 1.5 million. The total loans. Now, this one, the first 250,000 was utilized as at in project A as at 1st of January, while 500,000 was used in project B as at that same date. But the remaining 250 was used in the project to finance the project as at 250. That means these 250 that were used as at July 2006 will have been invested from January 2006 to June ending 2006. Before this loan will be needed in 2006 of 1st of July 2006, before it will be required for the project, it will have been used for January to June. So that means the interest of this 250, since it will be invested for January to June before it will be capitalized, the investment income on this, you calculate the investment income for January to June and deduct it when you calculate the total borrowing cost for the whole project, because the amount you need for that project is 500,000. This plus this will be 500,000. So the total borrowing cost is what is going to be incurred for the project, but the amount of investment income you get for January to June, you are going to remove it. This 500,000, 1 million will be required for asset B. But out of the 1 million you need, 500,000 will be drawn down as at 1st of January, while the remaining 500 will be drawn down as at 1st of July. It means this 500,000 will be available for investment as at January 2026. So if it is invested in January, that means investment income will be earned from January to June ending before this investment before the funds will be needed to finance this project. So by then the investment will be realized and the funds will be available to finance the project. The loan rate was 9%, and the Streamers Co. can invest surplus funds at 7%. Required to ignore compound interest, calculate the borrowing cost, which may be capitalized for each of the assets. So borrowing cost eligible for capitalization now. Capitalization, borrowing cost. Borrowing cost eligible for capitalization, we have asset A, and asset B. So the first one is January 1st. I've told you that the entire borrowing cost, 250 and 250, the total amount used to finance the project is what you need to pay interest on. That means interest will still be paid on the whole 500,000, not on 250. You are going to pay interest on the whole 500,000 you use for the whole year, since you have borrowed the whole money as at the beginning of the year. But the interest, the income will only be earned. It's only that the income rate is lower than the amount you are going to pay as an interest. So the interest now that will be paid on 500,000. So that is why you have your finance cost. Finance cost, which is the interest rate is 9%. 9% of 500,000. 9% of 500,000. That is finance cost. That is interest for January 20x1 till the end of the year, which is December 20x1. So you calculate 9% of 500,000, and that will give us 45,000. That is the interest that will be incurred for the whole year, 45,000. For the asset B, you also pay interest of 9% of the money you need to finance the project, which is 1 million. 500,000 plus 500,000, which is 1 million. 9% of 1 million. And that will give us 90,000. 90,000. That is the amount of interest you are going to incur as borrowing cost that is eligible for capitalization. So from this now, the interest for January to June investment income. The investment income earned from January to June, I said you deduct it. Since these funds were invested, these 250 that were not used immediately, it will be reinvested temporarily. And this 500,000 that was not used immediately will equally be reinvested temporarily. The income earned on 250 and 500,000, you are going to deduct it. And the rate of income is 7%. So you have 7% of 250,000. 7% of 250,000. And that will give us 17,500. If you deduct 17,500 from 45,000, you'll be left with 27,500. Then the other one, 7% of 500,000. And that will give us 7% of 500,000. That will give us 35,000. If you subtract 35,000 from 90,000, then you'll be left with 55,000. That is the borrowing cost, amount of borrowing cost to be capitalized. The borrowing cost to be capitalized. So the income earned from temporary reinvestment of the surplus fund, which is 7%. And the amount that will be reinvested temporarily, I've said, is 250,000. So in asset A, then you have 250,000 times 7% times 250,000 times 7%. And I've told you that the income will be invested from January to September. January to June, which is 6 months, times 6 over 12. Then for asset A, we also have 7%, which is 500,000, times 7% times 6 out of 12. So that would be 250 times 7% times 6 divided by 12. And that will be 8,750. So if you less that 8,750 from 45,000, then you'll be left with 36,250. Then 500,000 times 7% times 6 over 12. And that will give us 17,500. If you less that from 90,000, you'll be left with 72,500. That is the borrowing cost eligible for capitalization. Then after that, then how much will be the cost of the asset? You have to calculate the borrowing cost which may be capitalized for each of the assets, and consequently the cost of each asset at 31st of December. So cost of the asset now. Cost of the assets at 31st of December 20x6. 20x6, you have asset A and asset B. How much is the cost of the asset A? The cost of the asset. Asset A, the cost of asset A, 250,000 plus 250,000, which is 500,000. And the cost of the asset B, 500,000 plus 500,000, which is 1 million. Then borrowing cost to be capitalized now. In asset A, 36,250. And in asset B, 72,500. So when you sum it up, you have 536,250 for asset A and 1,072,500 for asset B. That is the borrowing cost eligible for capitalization.